Most retail traders don't fail because they're lazy or undisciplined. They fail because they're operating inside a structure that works against them. The distinction matters because if the problem is structural, no strategy or indicator can fix it. This channel focuses on how markets work through professional trading and macro frameworks. This is not financial advice and I'm not licensed advisor. This is analysis and not instruction. So, most retail trading advice starts with the assumption that the trader is the problem. You'll hear things like discipline, mindset, psychology, or patience. Those things matter, but they're secondary. The deeper issue is that most retail traders are forced to operate under constraints that professionals simply don't face. This isn't about intelligence or effort. It's about the environment you're trading in. Retail traders are usually pushed into very short time horizons, and small accounts, leverage, and the pressure to see results quickly all compress decision making. And that creates a fragile setup. When your time frame is short, even small fluctuations matter too much. Normal market noise starts to feel like risk. Simply, professionals don't operate like this. They can give positions time to work. You're not forced to react to every price movement. So the shorter your horizon, the more likely you are to confuse randomness with information. One of the most dangerous positions in market is needing to be right quickly. Retail traders are often over-leveraged relative to their capital. That means even a small drawdown feels existential. When being wrong threatens survival and decision-making collapses, professionals don't aim to be right often. They aim to avoid being forced out. That difference alone explains a large part of the performance gap. Retail trading is usually framed around outcomes. Like, did the trade win or lose? Was the prediction correct? On the other side, professionals think differently. They focus on process, exposure, and risk distribution. A good decision can still lead to a bad outcome, and vice versa. If you judge yourself only by outcomes, you'll reinforce bad behavior and abandon good frameworks. Markets don't reward confidence, they reward robustness. So, this is why most retail strategies eventually fail. Not because the idea is terrible, but because the structure can't support it. Leverage shortens patience, small capital magnifies emotion, noise overwhelms signal. Until the structure changes, switching strategies just rearranges the problem. Professionals start from a different question. Not will this work, but what happens if I'm wrong? That single shift changes everything. It leads to a smaller position sizes, longer horizons, and a focus on survival rather than excitement. The goal isn't to win fast, it's to stay in the game long enough for edges to matter. So, in conclusion, most retail traders don't fail because they lack discipline. They fail because they're trapped in a fragile structure. Until that structure changes, no indicator, strategy, or prediction will make a meaningful difference. Understanding that is the first step towards thinking like a professional. Thank you.